The UN Model Tax Treaty was developed with the developing countries' intentions and benefits more in mind compared to the OECD Model Treaty. Can you please give specific examples where the domestic tax rule still overrides the two treaties? Okay, so let's get into the answer. So the United Nations Model Double Taxation Convention between developed and developing countries and the OECD Model Tax Convention on Income and on Capital both serve as frameworks for bilateral tax treaties. However, they have different emphases, reflecting their target audience's interests. The UN model typically provides more favorable provisions for developing countries, often by allocating more taxing rights to the source countries, which are often developing countries as opposed to the residence countries, which are often more developed. Despite the international scope and intentions behind these model treaties, domestic tax rules of individual countries can and sometimes do override the provisions of tax treaties derived from either model. Here's some specific examples. So, controlled foreign corporation, CFC rules. Both the UN and OECD models do not address the specifics of CFC rules, which many countries use to combat tax avoidance through the shifting of profits to low tax jurisdictions. These rules typically allow a country to tax the income of a foreign subsidiary if the parent company is resident in the country and controls the foreign entity regardless of whether the profits of the foreign subsidiary have been repatriated. GAAR, General Anti-Avoidance Rules. Many countries have implemented GAAR in their domestic tax laws. These rules are designed to counteract aggressive tax planning and schemes that are intended primarily to avoid tax. If a transaction or series of transactions are primarily designed for tax avoidance and have no substantial economic effect, GAAR can be applied to disregard the tax benefit, regardless of any treaty provisions. Thin capitalization rules. These rules restrict the ability of companies to deduct interest on debt from related parties to reduce their taxable income. This is a practice that can be used to shift profits out of higher tax jurisdictions. With the OECD guidelines discussing these rules, not all treaty models fully integrate them, and they are generally governed by domestic legislation. Permanent establishment definitions, PE, while both the UN and OECD model treaties define what constitutes a PE, or permanent establishment, individual countries often have their own definitions in their domestic tax laws that can be stricter. For example, a country might define a PE in a way that is broader than the treaty definition to capture more foreign enterprises under its taxable presence criteria. Right. Then specific anti-abuse provisions in domestic laws. So countries may enact specific legislative measures that target particular areas of concern within their tax systems, such as rules targeting hybrid mismatch arrangements, tax havens, or other specific forms of tax avoidance strategies. And then the last one is diverted profit tax. Some countries have introduced a DPT, a diverted profits tax, aimed at companies that divert profits from the country to avoid taxation. The UK's DPT, for example, targets large multinational enterprises that use aggressive tax planning techniques to reduce their tax liability in the UK. So this is just an example where tax law specifically targets scenarios.